I'm going to introduce Ollie Beckett now, the portfolio manager, who tells me he's calling in from he's home in the Wimbledon area today. So he tells me if you listen carefully, you might be able to hear the roar of the crowd from centre court in the background. So welcome, Ollie. It's over to you, and I'll pick up at the end after the Q&A session, for the Q&A session.
Good afternoon, everybody. Thank you for joining us on a wet Tuesday afternoon. So, as Mike said, I'm the lead manager on TR European Growth Trust, which I've been that for the last 10 years, the lead manager. Basically, we invest in European smaller companies on the continent, so excluding the UK. So I'm going to try and give you a bit of an introduction to the trust, and maybe a little bit of some thoughts on where I think we are now. So if we go forward one more slide, and I'll explain why I think European smaller companies per se as a whole are interesting. That you can get exposure to some global leading niches. This also is a space that's very geared to global GDP. That may seem a bit odd, but historically it's more geared than larger companies. If you think of your sort of average sort of German Mittelstand company, it's very exposed to, exposure to China, America. So it's not all about just local markets. Historically, this space is geared to global GDP, which we're hopeful will pick up. But if you go forward and just one more slide, maybe in some ways this is the key. Look, if you're willing to be patient, European smaller companies has historically significantly outperformed its larger counterparts, as is the case in the UK and the US. This is where you find growth. At the moment, this year, that's not actually the case. It's sort of pretty neck and neck between small and large cap. And that sort of reflects that more recently growth has maybe slowed down a little bit, having come out of the pandemic. Now we're sort of seeing things like the Delta variant, so people are slightly more concerned, can we kick on from here? I would expect that, as sort of the vaccines kick in, and look, Europe has very much now caught up after a pretty horrendous start on the vaccine rollout. It has now caught up. And as we still see fiscal spend coming in, still see loose monetary policy, I'd expect to see a pickup in economic growth as we enter the second half, and I would expect small cap performance to reassert itself. Look, so I'm really, really biased, but don't even bother with large cap, okay? Historically, you're better off just sticking with smaller companies. And just going forward, another thing worth noting maybe is that European smaller companies, sort of on the same point, is very much geared to that economic pickup. So therefore, it's historically been very much correlated with something called the Eurozone Purchasing Managers Index, i.e. how much are managers of companies, what are they going to buy going forward? Is that going to increase? That correlation has broken down slightly. Again, I think because people have become concerned, will the Delta variant sort of run ahead of the vaccine rollout? Again, I would expect that sort of correlation to reassert itself, and for us maybe to see a pickup in a smaller company outperformance as we enter the autumn period. Maybe, and then going on another slide and looking at other reasons why European smaller companies is interesting. As I say, it comes down to growth. And as you see on the left-hand side, most years, small cap will deliver greater growth. Contrary to most people's opinion, in continental Europe, unlike the UK, these companies are less geared. There's far more family companies, management teams that just don't want to risk, the family silver. So they don't leverage up. It's a very different sort of management structure to maybe UK or US companies. And also, currently, they are also trading at a discount. Actually, this data is slightly out of date. Actually, in the last couple of months, Europe, as smaller companies, is now at historically high discount versus large cap, despite that greater growth. So at the moment, relatively, I think this is an interesting time to be looking at European smaller companies. I don't promise the returns of the last year, since we sort of hit the depth of last year with the COVID pandemic, but I still think it will be, you know, a positive place to be relative to maybe other spaces within investment markets generally. And going forward here, you can see, again, another reason why you might want to look at European smaller companies is that they're less well covered. And this is also where we start to see M&A. You know, these are the companies that are getting bought. And we've seen a lot of that in our portfolio in the last 6 to 9 months. We've seen a number of companies being bid for. Companies like Tarkett, a vinyl flooring company in France, EMA, Alstra-Munkel, packaging companies. Not hugely sort of exciting, go-go, techie growth companies, but companies where we've found value, companies generating cash, not highly leveraged, and then from people from outside the market, whether it's been management buyouts, families buying companies, or private equity, they are also recognizing that value. The other thing you see in the smaller companies is this is where you see the refresh of the market, if you like, through IPOs. Now, of late, there's been so many IPOs, so much equity issuance. I think it's caused a little bit of indigestion in the market. But this will always be an interesting area for us. You know, new growth companies coming to the market. And as you see on the next slide, I've given you some of the names of companies we've invested in recent months, which are recent issues. So that, and this outlines the point about niches. I mean, Cherry is doing mechanical switches for keyboards for gamers, i.e. people playing computer games where they want much faster reaction times on their keyboard. Vorwerk, an engineering consulting company working on transmission networks across Germany, gas, electricity, and even on a number of hydrogen electrolysis projects. You know, this whole electrification of Europe as we move towards decarbonisation, a lot of these companies are coming to the fore. So, you know, these are just examples. Smartcraft is a software company addressing the construction industry, an industry that sadly is a long way behind when we're talking software. So this will always be an important space for us. This is where, as I say, you get the new emerging exciting companies coming to the market. Then maybe moving on to a little bit to say why this trust. And there's a few details here about the trust itself, fairly self-explanatory. You know, we run a relatively long list. I don't apologize for that. We've always done it, a long list of stocks. We want to be able to invest, but also have flexibility at the low end of the market cap scale. You know, we want to be able to buy that exciting 200 million market cap company. So hence we will continue to run with a long list. The discount has actually widened since the end of May. We're now at about 11%. So clearly I need to do a better job of getting our message across about the appeal of European smaller companies and the performance it can generate for our investors. If you go forward a little bit, there's some mug shots of myself and my two colleagues, Rory and Julia. The three of us are dedicated to this trust and investing and looking at European smaller companies. But it's not just the three of us. You know, we will interact with a wider European team, our specialist property team, our specialist technology team. We have a team responsible for governance and ESG issues, which is clearly an increasingly important topic. So look, it's not just the three of us. It's certainly not just me. There's a lot of inputs into this fund, and we take information from wherever we can, and obviously, you know, talk to each other. And the weird thing is, during this last year, arguably the dialogue's improved. I'm not quite sure what to make of that, but you know, there's been constant Zoom calls. It's worked. Okay, so even if we go to a more sort of hybrid, in the office, working from home type model, I'm not worried about it. I think that can work, and it has worked very well. But otherwise, you've got a list of names here. But it's not just the Ollie Beckett show. Maybe trying to put this trust into context with the European smaller companies investment trust space. There are essentially only 4 trusts looking at this space. And what we are on this chart are the, I guess, grey dot, and then the three competitors are their respective colours. I guess how we would differentiate ourselves is we are true small cap, so we are a lower average market cap. And that I would argue that we are valuation aware. We are really not running a value fund. You know, I've already mentioned some of the recent IPOs. These are growth stocks. But what I don't believe in is overpaying. Now, that's always a subjective issue, but I don't think we can assume the low discount rates, the low inflation, the low interest rates we've seen over the last 10 years. I don't assume that the next 10 years are the same as the last 10 years. So I think it is important that companies, you know, are generating cash. It's not all just about trying to deliver top line growth, okay? And asset value is important, okay? Intangible assets are more important these days in the world of online, retail, etc. But valuation really does matter to us, okay? Going forward, just look, I'm not going to get bogged down in this whole sort of investment process. I'll happily take some questions. But what we're trying to do, we do lots of calls, you know, normally lots of meetings these days at Zoom. We run lots of screens. We're trying to find companies that are undervalued where we think the perception of the market is wrong. The other thing we're trying to do, because why we do all these meetings, is try and find inflection points, the points of change. Because companies that have been struggling for the last few years, things can turn around, okay? And I'll give some examples of that. So that's what we're looking for. Undervalued companies, perception wrong. Let's look for those improving returns, not necessarily buying the companies that are brilliant today, because maybe that's not sustainable, those returns. Maybe those returns will decline. You know, so that's what we're looking at, but I'll happily take any questions later. Going on, another thing that we do is, you know, we're looking at companies through a life cycle, a life cycle of companies. The fact that we're willing to go down the market cap scale means we can invest in those early stage companies. And sometimes that really bears fruit. I mean, today, HelloFresh, which is still in the portfolio, supplying meal kits, German company, is a 14 billion market cap company. But we got involved at the IPO. And yes, this has been a COVID winner, but I still think meal kits are probably there to stay. Okay, so we have taken some money off the table, but you know, I think meal kits have an attractive place for a number of families, for example. We will also, maybe more so than other people, because we're looking at inflection points, look at some of those turnaround companies. Nexans, French cable company, delivering high voltage cables, historically has been an awful company, not meeting its cost of capital. New management team come in, they cut costs, they close plants, and then they get the tailwind of an increasing demand for high voltage cables. If you think about that, those wind farms in the North Sea, they're no use unless they're connected to the national grid. That needs high voltage cables. And there's a similar thing with the transmission networks in Germany, or even in the US, where they're incredibly well placed. So we're always looking for that inflection, those turnarounds, and that's where you can make some pretty nice returns. On the next slide, I'll skip over it, but in terms of people like to say, well, what valuation metrics do you use? It really does depend on where that company is in its life. So I've just given some examples, but I'm not going to dwell on that here. And then moving on, you know, we've given some examples. I pointed out HelloFresh as one of those sort of early stage companies. Maybe moving on to the next slide. TKH. This is how companies can reinvent themselves. TKH was called Twente Kabel Holding. It was the Dutch cable company. Now they provide sort of cameras for production lines. They provide lighting for tunnels. They provide lighting for runways. They provide the kit that produces tires, which is now increasingly outsourced, and other examples you see here. And these reinventions are interesting because the market often misprices them, and that's the opportunity. Okay. And I've given you another example of a sort of turnaround on the next page. A French company called Quadient. Quadient does mail franking systems, you know, for your post. You're sitting in an office, a franking machine. Now people would think, oh, we're all on email, that's dead. Well, offices still need a franking machine. That still generates cash. And what has the company done? They've reinvested that cash. They're providing software solutions to that same SME marketplace. They've got a parcel locker business, another growth area. And then you start to see an inflection. You start to see a growth business, and you start to see a pretty cheap business on 10 times earnings, and you get that revaluation. And that is continuing. That's what we're trying to do. Not necessarily focusing on the latest sort of theme, you know, the latest hydrogen stock. Sure, these things are going to happen, but it's all about buying stocks at the right price. Maybe going forward again on, you know, why are we looking at valuations? Maybe if I can try and explain this chart a little bit. This is looking at the top 10% versus the bottom 10% on various valuation metrics. And what you can see in the last 10 years or since the financial crisis, on pretty much all metrics, the expensive has got more expensive. We know the logic, you know, inflation low, interest rates low, discount rates. Therefore, we can use very low discount rates. Is that going to be the same for the next 10 years? I don't think the risk reward is really there on some of these stocks, the 60, the 70, the 80 times earnings, the sales multiples. On the odd company, it will be. And we'll happily pay high multiples for high growth. Okay. But I think at the moment, expensive looks very expensive. And if you go forward, actually where we're going to see earnings upgrades, and I expect a pretty good earnings season in Q2 as we rebound from the horrific lows of last year and the pandemic, it's going to be in some of these cyclical stocks. They're a little bit out of favor in the last month. As I say, people are starting to, is there growth, isn't there growth? But I think what you'll see is this, you know, not the companies that have got the tough comparisons from COVID, i.e. the COVID winners, but some of these more cyclical companies will come through. The consumers will start spending. So this is where I expect to see earnings growth, and that can often drive share prices. And if you go forward another slide, this is saying, well, look, when growth was scarce post the financial crisis, it probably made sense to pay a higher multiple for those stocks. I don't think that's any longer the case. Growth is going to be less scarce as we come out of this pandemic. And then finally, from an economic perspective, this is looking at broad money supply without sort of getting into a sort of boring economics lecture, you know, money on deposit. Historically, when broad money supply is picked up, we've seen some inflation. All I'm saying is I don't want to bet against inflation. I mean, the thing we're going to have to look at, you know, do wages go up? Because then maybe this inflation isn't transitory. Maybe it's more sustainable. So look, we're not making a big bet on inflation, but it seems naive to me to bet against it in the coming years, you know, with highly indebted countries. The other thing we have to maybe more important look at from a stock perspective is when we're looking at inflation, is do companies have pricing power? You know, one of our holdings, Beckart, out of Belgium, they do the steel cords for reinforcing tires. They are doing very well currently. Demand is increasing. But they are also being hugely successful on passing on that extra steel price. That's what we need. So we need to make sure in all of our companies that they can have pricing power and can protect their margins. If you're going on, as I say, as we get out, the key, I guess, about, you know, does the economy kick on in the second half of this year? Do we maybe see inflation? It's going to come down to, do Europeans, do Americans, do they spend their savings? Or do we all stay sort of locked down in our houses and not travel and not go to the restaurant, not buy that I was going to say buy that dress. I'm not going to buy that dress, but you know what I'm saying. Do people go out and buy their sort of outfits to go out because clothing sales have been down? So I think there's a reasonable chance that as the vaccine rollouts become more successful, and they are in Europe now, and they are in the US and the UK, as that becomes more successful around the world, that we will see a pickup in consumer spending, and that will be good. Moving on, an important topic, increasingly important topic, is ESG. And look, Europe is at the center of this, and European smaller companies is very much at the center of this. This is where you'll find those pure niches. I don't know, Nordex doing the best onshore wind turbines, or whatever that might be. So it's not just this trust, but, European smaller companies is right at the center of this transition, this move towards sustainability. So almost de facto, you get probably a more sustainable type portfolio than you will in any other asset class. And you see on the next slide some of our holdings and their exposure. I don't want to go through all of them, whether it's KSB, sort of doing water pumps or energy pumps, whether it's Oerlikon in Switzerland, doing the alloys of metals, and therefore reducing carbon footprint. It's littered throughout our portfolio. And then we now just maybe look a little bit at the sort of positioning and performance of the portfolio. As a reminder, we're true small cap. Nearly half of this fund by market cap is under £1 billion sterling. So we're a true small cap fund. Don't have to be. That's where we can find some value. You go on to the next slide, you'll see the metrics on this fund. I mean, one thing I would point out is we've got high cash generation on a lot of the portfolio, and therefore quite high dividend yields. And actually, we have a number of financials, companies like Van Lanschot in Holland, a Dutch wealth manager, that if the ECB allows financials to reinstate dividends fully, you're going to be paying some, healthy double-digit dividend yields. So I think that's going to be a catalyst that we could see this month for a number of financials, which we are exposed to. So these niche financials, maybe surprisingly for a small cap fund, but that's where we're seeing value. And the PE on the portfolio is below the benchmark. It is considerably below my peers, but hopefully that sort of fits in with what I've said. But the returns are actually profile is slightly ahead of the benchmark. And as I say, the net debt to EBITDA on the portfolio, the leverage, if you like, the borrowing, is quite low. It's increased slightly recently because we've been buying into companies as they raise equity as they come out of this pandemic, particularly some of the Irish companies like Greencore doing sandwiches, or C&C, which is cider and a drinks distributor. So we've been adding to those sort of names for that recovery as we come out. The top 10 holdings are on the next slide. I mentioned Van Lanschot. The FDS is the Danish ferry operator, which also operates the cross-channel ferry, which is seeing some pretty good performance post-Brexit, despite people's worries. Recticel, Belgian insulation company. TKH, I mentioned. Westwing, online home furnishings, hugely growing customer base. Ariel Bank, doing property loans, but also a software company. Kindred, an online gaming stock with good exposure to the US. Manz is a very interesting company. This is a company barely covered that's producing the equipment to make lithium-ion batteries. They will probably, almost certainly be in every EV battery gigafactory that is made in Europe. And there'll have to be one in Europe, the UK, there'll have to be one in France, there'll have to be one in Germany. You're not lugging around lithium-ion batteries. They're pretty heavy. Quickly on the next slide, this is our sector exposure. You wouldn't be surprised. We're underweight bond proxies. We're overweight that pickup we expect to see in consumer spending and industrials. And then maybe finally to finish, this is the historical performance, which I think is healthy. We've done relatively well, certainly since You know, we've had a shift that maybe is slightly more to people caring about valuation, which hadn't been that important in various years since the financial crisis. But, you know, we're happy to switch. We'll buy growth. It's not a value fund, but we care about what we pay. So I will probably end there, and I will happily take any questions. But as I say, I think Europe and European smaller companies are still going to be an optimal place to be as we enter the second half of this year. I don't promise you that, you know, the great returns you've seen in the last year, but I think relatively, it makes sense to have some exposure to European smaller companies. And hopefully I've given you some insight and flavor into what we're about at TR European Growth. So thank you for your time, and thank you for listening.
Thank you, Ellie. And we've had quite a few questions coming in while you were talking. So thanks everybody for submitting the questions, and do keep clicking on the Q&A box and submitting more as we go along, and we'll try and get through them all as quickly as we can. Question here from Mark Bentley: what are the principal differences between your investment strategy and that of the Montanaro European Small Cap Trust? I'm guessing that Mark Bentley might be a holder of both, but could you elaborate on that a little bit, Ollie?
Yeah, look, firstly, in recent years, Montanaro's fund performance has been excellent. So hats off to them. And there were times, certainly a year or two back, where we were probably wrong. We sold out of various companies, which I frankly thought had just become too expensive. I couldn't really get my head around the multiples you were paying. When I sort of looked at the cash flows these companies were generating, I thought people were overpaying for some of this sort of top line growth. So they are a more openly growth orientated trust, whereas I guess we're slightly more balanced. You know, we will own some companies that are relatively mature. I mentioned DFDS, the Danish ferry company, which has performed well this year. You know, you can hardly say a ferry operator sort of gung-ho growth, okay? But we saw value. We saw, you know, a mispricing opportunity. So I'd say we're more a sort of balanced portfolio. My personal view is, as I say, if you're going to hold a lot of these expensive growth names, I think you have to be very confident that inflation won't emerge, because then at some point interest rates will have to rise, and it'll be very difficult to justify these very low discount rates people are using to sort of do a discounted cash flow to try and justify the valuation of these stocks. So we're coming at it from a different perspective. I'd say we're more value orientated. I personally believe as we go forward that the risk reward is slightly healthier by running a sort of more valuation aware type portfolio.
Okay, thanks, Ollie. One from John Allen here. Your investment team seem very UK biased. Any plans to recruit more continental European talent for a better local market knowledge and cultural fit?
Well, if we went all the way back to the picture of the team, just as a sort of reference, which is on slide 11. So there's three of us, and I can't deny that I am English. Rory would claim to be Scottish, but I'd say he's a pseudo-Scot. I mean, spent half his life in Guildford, so that's fair. Julia is Austrian, grew up in Vienna, and it's helpful to have a sort of native German speaker when talking to obviously German companies, because some management teams come across better in their own language. But even if you look at the European large cap team, Mark Schatz is from Luxembourg, Tom Lemegre is Belgian, Robert Schramm-Fuchs is German. So I think in the European team, yeah, we're slightly London-centric, we're slightly UK-centric because that's where we're based. But you know, I purposefully recruited Julia a few years ago. Well, she's good, okay? first and foremost, she is good at picking stocks and looking at companies, okay? But then, yeah, it's important to have someone that is a different age to me. It's helpful to have someone who's a different gender to me, and it's helpful to have someone from a different country, because clearly you look at the world through different eyes, and we're all sort of a product of our environment. So I hear you, it could always be slightly more diverse, maybe more Europeans, but I think we're not too badly positioned. And I've been looking at European smaller companies for sort of 20 odd years, gone to travel to Europe a lot. So hopefully managed to pick up a little bit of insight, though I will be the first to admit my linguistic skills are pretty awful. But yeah, I apologize. I should have concentrated more at school. But
Okay.
there you go.
Thank you, Ollie. And just looking at the team, you point out Henderson having a fairly large team there to support you, quite a mix of European talent in those teams. Are they kind of freely available to you? If you want them to get on a plane and go to a company meeting with you, that's not a problem, or
yeah, I mean,
how does that work?
Well, look, they're not there at my beck and call. Let's be honest here. But look, they're on the end of the phone, or they're in the office with me. And just as a point, I prefer the dialogue with an individual within a team rather than the sort of whole big team meeting thing. I mean, Rory, Julia, and myself will meet a lot to discuss the portfolios, etc. But outside our little small team, I want to talk to the relevant person. I don't want to sit in endless team meetings. I want to talk to the person who's done the work and knows the company. And there is a lot of overlap. I've done meetings in the last week with Robert and Mark. So yeah, it's about collaboration, I guess. But look, ultimately, there's not much going in this portfolio that I don't agree with. Well, nothing is, okay? So it's all about collaboration, but at the end of the day, someone's got to take responsibility and make a decision. And I guess that's where I step in, I guess.
Okay. All right, thank you. Question here from Bill Hall. Given the growth prospects in Asia, why should a trust specializing in European small caps outperform a similar trust investing in Far Eastern small caps over the longer term?
I'm not promising it will. I don't know. It's an honest answer. One thing I would say, Europe, as I say, is because of its, almost because of its positioning, partly because of its inadequacies, is geared to global growth. It does rely a bit on Asia. If you think of even your average car plant in China, it's going to be full of German kit. And we are dependent on the US. So it's all sort of interlinked. Beyond that, there are signs, and people will disagree on this, that Europe's getting its act together. The EU Recovery Fund is quite a significant thing. The fact that they did agree to the mutualization of debt, maybe that's a short-term thing because of COVID. But, from the Pandemic Recovery Fund, Italy, for example, is going to see a big boost. Do they make the most of it? I don't know. Do they learn from the failings of the past? But there's an opportunity. Europe, I've got to be honest, their companies haven't delivered the same returns as the US companies. Can they catch up? There's signs in certain areas they can. The valuations are more attractive. And ultimately, I've just got to try, okay, we've got quite a long list, but I've only got to find those handful of companies that I think can deliver it. And I think the historical performance of this trust, where most people will have said, well, Europe's been lagging Asia for the last 20 odd years, well, the returns on the trust to investors have been pretty healthy. So I think you can get pretty nice returns.
Mm-hmm. Mm-hmm. Okay, thank you. Matt Eva wants to know what the turnover of positions in the fund is on average, i.e. what kind of average holding period do you have?
Sure. I mean, historically, it's been about 40%, and then that went through the roof last year, truth be known. Okay. It went to about 60% when we saw sort of huge volatility And we did have to sort of change the portfolio a little bit, because when COVID hit, for example, anything that didn't have a strong balance sheet, I got rid of, because we just didn't know how long this pandemic would last. And to be honest, it's lasted much longer, and the impact's been far greater and severe than I ever would have thought. Dared sort of think in my worst nightmare. So the turnover did pick up, and there were a lot of opportunities also because of the volatility. We saw that extreme sell-off in March, and that created opportunities. So normally nearer 40, but last year sort of around 60. And hopefully that's a one-off, because it's a bit tiring, if nothing else, quite frankly.
Right. Okay. One on portfolio makeup here from Lily and Nandi. Roughly how many companies in the portfolio? I think you already mentioned around 120, if I recall.
A bit more than that's nearly 140.
140, beg your pardon. And could you give us a rough breakdown by sector and country on that? I think I saw something in the pack.
Yeah,
maybe
we can.
You didn't.
So maybe if we refer, there's a sector slide, I'll find it for you on page 30. I mean, genuinely, okay, first thing I point out though, genuinely we're coming from a bottom-up perspective, okay? So does that individual company stack up? And this is what sort of comes out, okay? As I say, we expect the consumer to pick up. We expect some pickup in industrials. You know, for the first time for a long time, I think we will see a pickup in CapEx. If the European Union and the rest of the world is serious, for example, about decarbonisation, it's going to have to invest. It's not all going to be about intangible assets and the internet, etc. So we're going to have to see some, you know, real metal bashing going on, for example. So that's how we are positioned today. I mean, maybe that could change. I mean, the real estate looks very low. That's because things like house builders, of which we own a couple, one in France, one in Denmark, actually come under consumer discretionary rather than real estate. So sometimes this is more to do with how the indexes define things. The country weightings I actually put in the appendix, so I will find them somewhere. I say I'll find them. Maybe I won't. I think they're here on slide 44. Far too many slides, I apologize.
Well, it's quite a useful pack for post-webinar research if anybody wants to go into that kind of detail. Yeah. There's plenty in there.
Any of you out there with insomnia, there you go. So look, that's the country weightings. Again, I wouldn't get too het up on it. It's about where we find the ideas. Now, Swiss stocks are relatively expensive, I would say, but it's where we find the ideas. You might be a little bit sort of questioning, well, how come the United Kingdom turns up? In reality, it's, you know, it's, for us, it's where companies are registered, and a number of the Irish companies are listed in the UK, so that comes through as the UK. Okay. So again, that's up. Maybe the weighting in Ireland is slightly greater, and we don't really have any pure UK type companies.
Okay, thank you for that. So I take it from what you're saying in terms of sector and country, you're fairly agnostic. It's about, you know, bottom-up analysis of individual companies, so that both country and sector mix will vary over time. Yeah,
it does. I mean, look, there are certain spaces we are unlikely to go. Okay, we are unlikely to go into biotech, because I mean, I'm not an expert on anything, but I really don't understand it. I mean, I hope, you know, whatever, you combine this molecule with this molecule and you cure this, but I don't feel like we have a good feel for that. I'm not favouring pure exploration companies. You know, have they struck oil? Well, I don't hang out in the bars of Oslo, so I'm probably not going to be the first to know. It's the truth, okay? And again, I find those things sort of difficult to value. So there's some spaces we won't go, but other than that, yeah, it's pretty much a bottom-up call.
Okay, thank you. And just as a subsidiary to that, do you see where, if you're looking forward, have you got any views as to where you would see the biggest opportunities emerging in the medium term, both in terms of sector and country, or at this stage, or do you not think like that at all in terms of the way you go about your investment process?
No, I mean, there's a bit of a timing thing. As I say, I mean, Europe's playing catch up a little bit on this vaccine rollout. So you can sort of see what's happening in the UK as we come out of this pandemic a little bit quicker. But certain things in Europe have picked up quicker. I mean, travel intra-Europe has picked up. Was obviously there's been a bit of an issue for the UK. And you can see that, okay, people are thinking, oh, well, maybe people will continue with this staycation. Well, demand for, you know, Northern Europeans, Germans, etc., going to Southern Europe has gone through the roof, okay? People want that sunshine, okay? They've had a year of staycation and sort of thanks very much. They want the guaranteed sun. So I think things like this are going to come back. Some winners from the pandemic, I think will continue to be winners. You know, gaming is going nowhere. You know, it's going to continue to grow. That wasn't just some sort of pandemic thing. Sure, the shift to online retail was accelerated, but again, it's not going to go away. But yeah, and there's other things, as I say, this whole electrification is happening, you know, the decarbonisation. So companies like Nexans, you know, are very well placed. They expect that to continue. The signs are the pickup of electric vehicles is going to accelerate. You know, short term, the auto manufacturers are struggling a little bit with semiconductor shortages and other supply chain issues, but the demand seems to be there. So look, I think there's numerous sort of growth themes. As I say, I expect to see a pickup in consumer spending. I don't expect people just to bunker down in a cave for the next year or two, and sort of out of fear. I think all the signs are that people want some normality. Yeah, they might like working from home, but in terms of going out in restaurants and seeing people, and we can benefit from that and try and invest in those companies that benefit from that. So, yeah.
All right, thank you. And Craig Thompson would like to know, do you have any plans to remove the performance fee? And do you think this would increase institutional demand if you did? I guess it might also increase retail demand, but is that something you have an opinion on and are willing to share with us?
Clearly, I've a sort of favourite, but look, you only pay it if the performance is good, okay? So, and that's on a 3-year rolling view, and the last couple of years there hasn't been a performance fee because a couple of years ago the performance was lackluster, so there was no fee. And in that situation, the management fees we charge are below that of our peers, okay? So you can cut it, people will have different preferences, but here you're only really paying, you know, you're only going to pay more than my peers if we deliver the goods. I think it's fair. Personally, I don't understand why people are anti-performance fees. If it was myself, and as a private investor, I'm all in favor of them. You know, you deliver performance, we pay. But if you don't deliver performance, we don't pay. So, but yeah, I might have a slightly biased view. It doesn't seem to have discouraged that many institutional investors. You know, ultimately, it's going to come down to, can we deliver?
Yeah. Okay. Thank you. In terms of share price discount to NAV, could you just talk about the triggers you see that are likely to close this or to achieve some kind of trading at a premium?
Sure. So we haven't been at a premium for a couple of years, and if I think back to when we were at a premium, I mean, the truth is European smaller companies was more in favour. At the moment, there seems to be a slight reluctance, maybe more amongst UK investors. Maybe people are looking at the sort of pig's breakfast the countries in Europe initially made about the vaccine rollout. But I promise you, in the last month or so, you know, most of these countries, particularly like Germany, have really got their act together. So maybe the skepticism about Europe, skepticism about change in Europe. But I think ultimately what we've seen in the past is if people get more positive about Europe, positive about smaller companies, and we deliver some decent performance, that discount will narrow. I'm hopeful, as I say, further into this year, as economic growth hopefully recovers, as long as this Delta variant doesn't get out of control, there's always risks, then economic growth picks up. And as I say, in that environment, European smaller companies tend to come back into favor. So, and maybe I need to do a better job at this sort of thing in terms of marketing and getting the message out there. Maybe people don't realize the returns you can generate, not just from us, but in European smaller companies. So maybe we need to do a better job of getting that message out.
Yeah, sure.
Partly why we're doing this sort of thing.
Yeah, it's very noticeable that the overall, even adding in your three peers in that European small company sectors, it's not a big sector in terms of the amount of investment going into it at the moment compared to some other equivalent sectors in other countries or regions. If got one here about the management team, have you got serious skin in the game? I think Edward Osicki probably that's fairly clear what he means by that. Could you give us any comments on that?
How do you want me to answer that? Pretty serious, yeah. I personally have, multiples of my salary in the game, put it that way. I have far more equity exposure to this than anything else, including the company I work for, multiple times over. This is where most of my wealth lies. Okay,
that is very useful to know. So thank you for sharing that with us. There was a related question down below here about how big a stake in the trust do you and the trust's directors have? That was from Bill Hall. I guess the directors' holdings will be on public record.
Correct.
I did have a quick look earlier. They were quite low, actually, from what I recall. I
don't think that's for me to comment on, really.
No,
I think they all have some exposure.
Yes, they've got some, but I would say it's not massive in terms of fairness, their net wealth.
Yeah, no, but if you're a EU citizen, it gets a little bit complicated, in fairness.
Right.
So for the EU members of my board, it's not quite that straightforward, sadly, to invest in a sort of tax efficient way in an investment trust.
Okay, thank you for that. One from John Allen here again. TRG is much more highly geared than your peer group at the moment. And could you just share with us a bit more about your policy on gearing and also in terms of your gearing arrangements, the flexibility you have around those?
So we're about 10% geared today. So I haven't looked at my peers. I guess last time I looked, I think they were around 5-6%. I mean, if you did the maths, it's not going to make a massive difference to performance. But in terms of how much we're geared, it's a combination of, how do we feel about the markets, valuations within the markets, and from a bottom-up perspective. The gearing gives us flexibility. We don't have to sell. It's not like some open-ended fund where we're getting cash calls and we have to sell and then not maybe selling at the wrong time. It allows us to, buy companies, so hopefully it allows us to get the timing right. I've got an agreement with the board that I can take the gearing up to 15% without going to them to ask to gear it more. That's unlikely, in fairness. You won't really have seen the gearing above 15% in the last few years. And though we have a facility that enables us to go over 20, so there is flex there.
Right.
But that's, I think the majority of the time we will be geared. The majority of the time you can expect equity markets to go up. But if we become more negative about the situation, we can reduce that gearing, and we will reduce that gearing. But in all likelihood, I guess 2/3 of the time it will probably be between 5 and 10%.
Okay, thank you. Question here about governance, really. Again, I appreciate you're the investment manager rather than a member of the board.
Sure.
But what is, if you can share with us anything, what's the latest situation with board succession planning? I think John Allen notes that Andrew Smith, I think, was asked to stay on for an extra year at the last AGM due to the unusual circumstances of COVID. But can we assume he presumably is stepping down this year? And Alexander Mettenheimer, he's been on the board now for 10 years. So it's actually a hot topic for us as an organisation, that we do like to see board members stepping down after 9 years, if at all possible, because we do think they start to lose their independence when they've been around a bit too long.
Yeah, okay. I mean, I get the general principle. So, I mean, Andrew Martin Smith, I mean, as you say, that was more a one-off in the situation we were in last year. You know, again, I think the expectation is that Andrew will step away. He's been very helpful. His Interinvestment Trust board experience is also, you know, being very useful and helpful, very helpful to the rest of the board, and very helpful to myself as a manager of the trust. But yeah, I think that transition will naturally occur. I think we're very aware of the situation. It's not entirely my call, as you say, but the transitions will occur. For me, I'm not going to get too het up personally about whether it's 9 years, 10 years, 11 years, but I think the principle has to be there that you need to renew the board.
Yeah.
And that has been ongoing. So I think you can expect that to continue. And what we said about with regards to Andrew was factual. You know, it was a one-off effect because of the one-off situation we were in last year.
Okay, thank you. Just while we're on the board constituents, I do recall there was a fairly heavy vote against Chris Casey as, I think was it his first year as chair last year? Again, I think he's been on the board for about the same time as Alexander, maybe 11 years, but he's only recently
become chairman.
Chair, yes. And there was a fairly significant vote against him at the last AGM, and I think the board agreed to enter into discussions with those who'd voted against. And I presume I just haven't seen anything public about that in terms of why the vote against, what was driving the vote against, and also what has been the subsequent decisions or agreements.
I think some of those votes against were because of things like you said, and were slightly mechanical in terms of, these are the rules we vote against.
Right.
I'm also aware that Chris Casey has engaged with a number of the larger shareholders and tried to alleviate some of their concerns. You know, look, from my perspective, he's doing a great job and being hugely supportive, getting heavily involved in trying to promote this trust and favouring things like doing this webinar, you know, so trying to get our message out there. So look, for me, he's been hugely supportive. He's engaged with some of the larger shareholders. You know, he hasn't had to be, he's had to do, he's been very proactive on that front. But, you know, in terms of public disclosures along those lines, no, there haven't really been any.
Okay, thank you. I guess we'll expect something soon. It's the AGM year-end information will be coming out soon, I guess.
We're a June year-end, so autumn is the time of the AGM.
Yeah. We've sort of half answered this one, I think. How long do you aim to hold companies, and are there triggers for sale that you could tell us about?
Yeah, I mean, you sort of go into, well, I guess we go into this sort of, in some ways, trying to look at a sort of 18-month time horizon, because to look beyond that gets a little bit tricky. I mean, sometimes you do. And you always have a sort of, aspirational plan of how things might pan out and what catalysts might occur at various points. Nothing ever really runs 100% smoothly in some ways. You know, sometimes things come earlier, sometimes things come later. So it's always a question of reevaluating, okay? And we don't sit there and go, well, we're going to sell these shares when they hit 23.5 or something like that. Look, anyone that, I've worked with loads of people that said, oh, we set price targets and we stick to them rigid. Absolute codswallop, okay? And understandably, you reevaluate things because the world changes, okay? So that's what we do. So it's constantly looking at share prices and then sort of going back and questioning ourselves and going, well, are things going to pan out as we hoped? Is it going to deliver the growth we thought? Are the margin expectations realistic? And therefore, where do we get on the valuation? So it's constantly questioning, it's constantly being cynical, and it's actually going back and looking at the numbers. You know, one thing we use is there's a tool on the Credit Suisse own called HALT, which is sort of cash flow return investment tool. And it enables you to sort of play around with the numbers, look at the top line growth assumptions, look at the margin growth assumptions, and then say, does that valuation make sense? And, you know, and for us, you know, we've sold companies that, with hindsight, you know, things like Cinch, messaging companies out of Sweden, Soitec, semiconductor company out of France. We sold a number of these names too early, it looks like at the moment, but because they've continued to go up. But we can't make the valuation make sense. So look, we're constantly checking these things, but it's always reevaluate.
Okay, thank you. One here from Bill Hall. I think this is the test of your sanity or your rigorous evaluation. Did you invest in Wirecard?
Here we go. Yes. Okay, so, well, I wasn't the lead manager at the time. So we're going to go back, I don't know, I'm going to say 15, 20 years. And we did invest in Wirecard and we owned it. And until Wirecard imploded, our decision to sell Wirecard, when I was the lead manager, was the worst decision we'd made, statistically. Why did we sell it? And we did sell it 5 years ago, more, 8 years ago. Maybe even more than that, 8, 10 years ago. Right,
well before all they hit the headlines.
But we sold it. Let me be honest with you, because there are a number of warning signs. Why did an ex-investment banker CFO not own a single share? Why did they continually raise cash when for new deals when they apparently had lots of cash sitting on the balance sheet? You know, that's an unusual thing to do, to pay up to borrow cash when you have cash. And in fairness to Rory Stokes, he genuinely picked up the annual report and pulled it apart, and we couldn't make it make sense. We could not make the cash flow statement make sense. But, you know, that's it's a number of years ago. So we did briefly own it. Selling it was, as I say, I sat down in a risk meeting where I was told, why did you sell this stock? That's the worst decision you've ever made. And I went, true, but I still think it was right. But it wasn't proven right for a number of years.
Yeah, okay, thank you for that. So you get 10 out of 10 from Bill, I suspect, for that one. One more, I know we're a little bit over time. Just the last question, because it's slightly different here, we haven't covered this area. Do you invest in any private companies?
Historically, before, again, I took over this trust 10 years ago, we did. And we had a large holding in a company called BrainLab, which is a really good private company in Germany, providing equipment for cancer treatment. But look, we will never do it again. As I pointed out, we run a relatively long list of stocks. If you're going to invest in private companies, you should have a very short list, half a dozen names. We are not geared up for that. We're not geared up to be engaging with the board every 5 minutes, putting pressure on the board. And you just don't, we didn't have any control. It was very much run a one-man show. So we won't invest in private companies. It's going to be purely listed, things that are all fully tradable, where there should be no discrepancy over what this asset is worth. Okay. Well, it's certainly in terms of a share price perspective.
Okay, no, it's good to know what to expect going forward. A lot of other investment trusts are obviously quite active in the private sector.
Yeah, we won't be going anywhere near it, I promise.
Right, so thank you, Ollie. Excellent. We've run out of time, but we've also covered all the questions. So thank you very much for your time. And we didn't hear a single cheer from Wimbledon, so I think they will still have the roofs on.
I don't think these are big matches, but no, the doors are shut. I didn't think you wanted that. But look, thank you very much for listening. And hopefully it was of use and of interest. But thanks for your time on a Tuesday afternoon.
Thank you. Enjoy the rest of your day.